Hey everybody, this is Kevin, a CPA that does financial planning, and today I wanted to talk about the elephant in the room. A recession is coming. That's all we hear. And this is from GQ magazine. Now you can tell by the way I dress that I am not a GQ reader. I wish I was. I respect those of you that dress extremely well. But when GQ comes out with an article that says, should I be freaking about all this recession talk? And then they say you don't need to liquidate your sneaker collection and buy gold, but there are signs of trouble ahead. I think it's important to address this. What happens if a recession comes? Well, as a financial planner group that Charlie and I work with, we believe that you should always lower debt, try to make sure that your cash flow is good, and make sure that you're not going to live too big of a life. That's the first thing to do, as always. But now let's just talk about the portfolio. What can we do with our portfolio when a recession comes? Well, here is actually a chart from the folks at JP Morgan, and they share with us all the different recessions that have happened since 1947. And we can see that there's 11 recessions. But the interesting part is that there are more than 11 20% downturns. And I will say as well, in 18, although this doesn't come to 20% downturn, it actually was a peak to trough. At some point in time during the year, on December 24th, the market had been down 20%. And so there was a peak to trough of 20%. But the first thing you notice is that, yes, recessions do correlate pretty strongly with downturns. We do see that. But we see there was two market corrections in about 62, 66. There's another little blip down here before 57. We have in the early 80s, and then we have the flash crash when I was a junior in college studying finance. Yes, the flash crash. I remember that on Monday. One of my professors didn't come in. The market went down big time without a recession, okay? So I think it makes us feel better in some ways to know that when there is a recession, there is a major downturn. Now, the other thing to note is that in some recessions, there was, a pretty good downturn, but the last two downturns have been pretty massive, okay? This recession, and this is the amount of time, was pretty long, and it was pretty painful. So the issue is first of all, do we know when the recession is coming? No. Second of all, will a recession come? Yes, absolutely. Australia, I believe, is the developed country that has the longest GDP that has not gone into recession. If you define recession as two negative GDP numbers, that is, the economy contracts, and that's how a recession is determined. Many times I will remind everyone that when the recession comes, when you find out about it, it's probably already happened because, many times we don't know we're in a recession. We know things feel bad. The market may go down. We know things feel bad, but we actually find out after the fact. So a recession and a market downturn don't always mean the same thing. But let's say that there is a recession and a market downturn. What can you do with your portfolio? Well, let me share with you an idea. So this chart here, and I'm cherry picking the last 20 years, but it makes a pretty decent point. Now, it shows that a 50% stock, 50% bond portfolio over the last 20 years actually had a 5.85% return. So this is a very simple portfolio, U.S. stock, S&P, total aggregate bond. The S&P 500 itself had a 5.9%. But it took about, 16, 17 years before the stock portfolio, stock portfolio pulled ahead. Now, this is because of correlation. And this is also because of one of the greatest bond bull markets we've had, it's the last 30 years, maybe longer, where bonds have just gone through the roof. And so this is why we say that you should have some humility when you invest, and you should format a plan and then stick with your plan, because everybody knows that stocks outperform bonds. Everybody knows that. But the first 17 years, you actually did not outperform a stock bond portfolio. So even though everybody always knows everything, it doesn't always get realized. So here's the most important thing that you can see And if you can learn this might be very helpful for your investment lifetime, okay? This little chart right here, on the on the x-axis we have volatility, standard deviation, how much movement, how much times do we not hit the mean? Do we have either above or below the mean? Left tails, right tails, all that stuff you hated in college. So the more volatility, the more you go up and down. And then so this 50-50 portfolio, you can see the volatility was 7.1%. Return was 5.8. S&P 500 had a volatility of 14.6. Now what we don't mind is if the S&P 500 is up here, we don't mind that because we get a higher return, more volatility, we're happy. Now why does the portfolio have so much less of a volatility than the S&P 500? It's because of the bond aggregate. So the message here, and this is very individualized, but what is the right portfolio for you? It may be made up of stocks and bonds, where the bond portion of your portfolio will pull down the volatility. Let me show you another way to look at this. Quanti does a really wonderful job here. So Quanti says, Larry Swedrow, I heard him say this recently, so what is the contribution to portfolio risk in a portfolio? And we're looking at the S&P 500 makes up 96.5% of the risk, where the bond portion only makes up 3.5. So although it's a 50-50 portfolio, the stock portion of it really is the portion that makes up the downdraft, the concern of downdraft. And here is looking at the last 5 recessions, market downturns. Asian crisis, Russian long-term capital management crisis, the tech bubble, the World Trade Center attack. You can see what a 50-50 portfolio did in these downdrafts versus what 100% equities did. One of the things I've noted with certain clients is they say they hate bonds, and I get why you hate bonds. I don't think bonds are sexy, but what bonds do is they create a correlation. And here, I'm going to show you what this correlation thing is, but just look at this, okay? The bond correlation is a negative 0.13. All right, so I know you hated statistics, but just bear with me for one more minute and then we'll end this thing with some conclusions. Okay, so correlation. Investing. If you have a 1 correlation, that means 100% of the time, if one asset goes up, the other asset will go up exactly the same amount. If it's a negative 1%, which is not on this chart, that's a negative 100% correlation. That means when one asset goes up, let's say S&P 500 goes up 100%, the other asset will go down 100%. So would you want 2 assets 50-50 that had 100? That had a totally 100% negative correlation? No, you would always be getting a 0% return, okay? So we like to have the equities, which have a positive expected return. We like to have bonds that have a positive expected nominal return, and we like for them to have some negative correlation, okay? Now, a 0 correlation, this is where it gets really confusing, means that they just move independently. But so anyway, high yield bonds, emerging market bonds, European high yield bonds, these are low credit quality. These move more like stocks. They're like poor man stocks. The US bond aggregate you saw was negative 0.13. So in this chart here from JP Morgan, it's showing to be around 0. In the other chart for the last 20 years, it's been a little bit negative. If you want to own a couple of asset classes and you want to lessen the volatility, that is, when a market crashes, you don't want to go down as much, you would add treasury bonds. Okay, the 2-year treasury bond has a negative 0.4% correlation. That is when stocks go down. Typically, I have to say typically, because we never know for sure what's going to happen in the future. Future's unknowable, but they'll go up. And so this correlation thing is the beauty of modern portfolio theory. It's the beauty of risk-adjusted returns, that if you add 2 asset classes that have different zigs and zags, you can actually lower the volatility. And to prove it, again, we go back to this chart right here, which shows by adding a less volatile asset that goes in a different direction, the volatility here is 3.4 to an asset class of S&P 500, which is 14.6, we get 7.1. And that's why adding bonds can help in a recession. Please call Charlie and I and let's discuss this. Again, thanks everybody for watching. Kevin, a CPA that does financial planning. Thanks.